As a Delawarean, it's a real pleasure for me to introduce our next speaker. He may not even realize it, but he has wonderful Delaware connections in his resume. Professor Skeel, David Skeel, is the S. Samuel Arsht Professor of Corporate Law at the University of Pennsylvania Law School. As a lawyer who spent most of my career at Morris, Nichols, Arsht, and Tunnell, and had the pleasure to practice with Sam Arsht. I'm glad to meet the S. Samuel Arsht Professor of Corporate Law. He is the author of Icarus in the Boardroom, The Fundamental Flaws in Corporate America and Where They Came From, and also of Debt's Dominion, A Political History of the Bankruptcy Law in America, and also of numerous articles on corporate law and corporate insolvency. He has written commentaries on corporate law and related issues for the New York Times, Financial Times, Los Angeles Times, and even the esteemed Philadelphia Inquirer. Professor Skeel earned his law degree from the University of Virginia School of Law, and after law school he clerked with Judge Walter K. Stapleton on the Third Circuit Court of Appeals, although someone of my age, I had the pleasure of clerking on the District of Delaware at a time when Judge Stapleton, who is a Delawarean, was on that court. So it's a great pleasure to introduce Professor Skeel. He served his private practice years at Duane Morris and Heckscher here in Philadelphia. Thanks so much.
Can we pull up the PowerPoints? They're not critical. I'm a little embarrassed after that lovely introduction about all my Delaware and corporate law connections that I'm not going to be talking about Delaware or corporate law, at least initially. They should be on the screen. So if you get out of this, it's actually not that critical. No, that's fine. Thanks. I should also note that this was originally a tax panel, and I'm also not going to be talking about tax. I hope that at some point during the day, somebody will teach us about carried interest and whether that should or should not be taxed currently, which is a hot debate, I think, right now in Washington. But as my students and corporations know, I know very little about tax. And since I don't know very much about tax, I thought, what can I talk about? One thing I know a little bit about is bankruptcy. Bankruptcy has some things in common with tax. It's arcane. It's a mind-numbing statute. So I figured probably you all would be fairly asleep by now anyway, and you wouldn't notice the substitution. So I'm going to be talking about hedge funds in bankruptcy for the next 20 minutes or so. If I can figure all this out. Oh, yeah, I don't even know what to do with that. Actually, I could, hopefully, it'll work. Okay, so brief introduction about hedge funds in bankruptcy. As is already evident and will continue to be evident for the rest of the day, most hedge fund discussion tends to focus on the relationship between hedge funds and corporate governance and some of the potential problems. We really haven't hit a lot of the problems. Richard denied that there were problems. Troy hit a couple of them. I think there are some. Probably Henry Hu, when he talks to us, will talk about some of the potential problems. And the things that he will talk about are quite similar to a couple of the things I'm going to talk about. So I'm not going to talk about hedge funds in corporate governance, at least directly. I want to talk about them in bankruptcy. They are at least as important in bankruptcy, in corporate reorganization, as they are in corporate governance, and there are all kinds of connections between the role of hedge funds in corporate bankruptcy on the one hand and their role in corporate governance on the other. So what I'd like to do for the next 10 or 15, 20 minutes is very, very briefly describe the benefits of hedge funds' presence, and then in much more detail talk about some of the problems in and around bankruptcy of hedge fund involvement, and I'll do that by talking about 3 specific kinds of problem scenarios, places where hedge funds, which are doing what they do best, which is make money for those investors Troy was talking about, actually might not be doing so well for the rest of us. So that's will be the heart of what I'll talk about, and then I'll conclude with a couple comments about what we might do about it, about possible regulatory responses. On this point, I'm actually sort of on the same page with the other folks who have talked, although I am worried in some respects about the role that hedge funds play. I would be even more worried if we were too aggressive about how we stepped in as a regulatory matter. So that's where I am headed. The briefest part of the discussion, what's good about hedge funds, I want to at least acknowledge that they do perform some beneficial, they have a beneficial function in many respects. In bankruptcy, what those benefits look like, well, they are very, very sophisticated. They are very active. Why does that matter in bankruptcy? Well, 20 years ago, the standard line about the American Corporate Reorganization System, Chapter 11, was that debtors are in full control, that once a firm files for bankruptcy, its creditors get stiffed, the debtor can do whatever it wants, and everybody except the debtor ends up losing money. Creditors' value is expropriated from creditors in bankruptcy. That was the standard line 20 years ago. That is not the standard line anymore. And the reason that's not the standard line anymore is because creditors play a much, much more active role in bankruptcy than they used to. Foremost among those creditors now are hedge funds. Unlike other creditors, when a hedge fund is involved in a bankruptcy case, they don't just sit there. They very, very actively participate in the case. They put pressure on the managers of the company. And what the effect that has is it really reins the managers in, and it has, in the last 5, 10, 15 years, led, in my view, in the view of many, to a more effective bankruptcy process that actually tends to leave everybody better off. So one thing that hedge funds do is they're active players. They don't just roll over and let the debtor of the insolvent debtor do whatever it wants. Another thing that hedge funds have done is they've increased the pool of potential financing in bankruptcy. A key part of a bankruptcy case when a large company files for bankruptcy is its financing, whether it will be able to get additional capital to keep going. Hedge funds increasingly are lenders in these cases, and they've expanded significantly, therefore, the pool of potential financing. So that's the good stuff about hedge funds. Some of the bad stuff about hedge funds are some of the things that we have reason to worry about, in my view, are the 3 scenarios that I will talk about now. The first problem is not a bankruptcy problem. It's actually more of a pre-bankruptcy problem. So I guess in a sense this is corporate governance related. Poster child for this kind of problem is a case from a couple years ago called Tower Automotive. In that case, there was a syndicated bank loan. The major lender of Tower Automotive was a bank syndicate with a lot of banks, I forget how many. Hedge funds, a group of hedge funds, bought a piece of that syndicated loan. This is all prior to bankruptcy. Tower Automotive runs into financial trouble. It wants to renegotiate its loan so it doesn't have to file for bankruptcy, and maybe everybody's better off. The banks say, this sounds like a great idea, let's renegotiate. The hedge funds say, no way, we're not going to renegotiate at all. Turns out that the syndicate had a unanimity requirement in it. Everybody in the syndicate had to agree, or the bank loan could not be renegotiated. Since the hedge funds said no, the bank loan was not renegotiated. Tower files for bankruptcy, and I don't even remember what happened in the bankruptcy, but most people think that a lot of value was destroyed by putting them through the Chapter 11 process rather than at least trying to keep them outside of bankruptcy. So why did the hedge funds say no? Why did they not agree to renegotiate the syndicate? Well, it's possible they had different information than the banks did. It's possible that keeping Tower Automotive out of bankruptcy was not a good idea. What a lot of people think happened, and there were a number of stories in the Wall Street Journal in particular about this, is that the hedge funds had actually shorted Tower Automotive stock. And so the hedge funds had a financial incentive to destroy value so that they could make money on their short position. The idea was the price of and what they expected to get out of their piece of the bank syndicate was more than offset by, or any value they might have lost because of their interest in the syndicated loan was more than offset by the value they gained by shorting the stock and profiting when the stock tanked because Tower filed for bankruptcy. How is all of this possible? Well, this is possible for the kinds of reasons that people talk about when they talk about hedge funds. There are upsides to these reasons, but there are also downsides. The things that make this sort of a scenario possible, the main things that make it possible are, one, the active market for new financial instruments and a very liquid market for shorting stocks. That actually is a good thing. I agree with Richard about that, but it makes possible this kind of a maneuver. The other thing that makes it possible is the lack of transparency. Nobody knew exactly what the hedge fund's position in Tower Automotive was. In this case, at least, it looks like they were making lots of money for their investors. We didn't have to worry about their investors being ripped off. What we needed to worry about is everybody else being ripped off, at least to the extent that value was destroyed. So that's problem scenario number one. Problem scenario number two, which is very bankruptcy specific, is illustrated by a case from a couple of years ago called Radnor Holdings. And what happened in this case, and this has happened in a number of cases, is that a hedge fund made a loan to the bankruptcy debtor, Radnor Holdings. This actually was a pre-petition loan, a before the bankruptcy loan. The hedge fund also lent additional money in bankruptcy to finance the bankruptcy process. The company was not able to reorganize in bankruptcy. What they ended up doing was selling the company, trying to sell the company, which is what the hedge fund wanted all along. Who's the main bidder at the sale? Well, the same hedge fund that had lent money to the company was the main bidder. What the hedge fund did is it credit bid. It bid the amount of its loan as its bid to purchase the assets of Radnor Holdings. Nobody else really shows up at the auction, so the hedge fund ends up buying Radnor Holdings. Is that necessarily a bad thing? No. That might be a good thing if the hedge fund is the best purchaser for the assets of the bankrupt company, but there are reasons to worry about this as well. And the main reasons to worry about this, or the main reason, is the possibility of asymmetric information. Once the hedge fund lends money to a corporate debtor, it has access to more information about the corporate debtor. It has access to ongoing financial information as a part of making its loan and monitoring its loan. That has a tendency to scare away other possible bidders. If you are a potential alternative bidder, you're going to think twice about bidding against the hedge fund because you can assume the hedge fund knows a lot more about Radnor Holdings than you do, and if you beat the hedge fund in a bidding contest, you have probably bid too much. If the hedge fund gets out of the bidding contest, it's probably because you're overbidding. This is a phenomenon known as the winner's curse in auction theory. Information asymmetry, if you have a hedge fund lending money to the debtor, then turning around and also bidding for the debtor, you have a possibility of that what's happening is the hedge fund will be able to buy the debtor or its assets too cheaply, which will have the effect of taking money away from the other creditors. If the hedge fund buys the company on the cheap, other creditors lose out. Again, this is a strategy that's wonderful if you're a hedge fund investor. It makes money. There's nothing illegal about it. But it's something we might worry about if we're worried that we're going to chill bankruptcy auctions when we allow this loan-to-own strategy to go forward. Final problem that I'll talk about. I thought I had become less of a hedge fund critic over the last couple of years, but I'm starting to sound like more and more of a hedge fund critic. What are the questions with all of this? And it's an open question, and I'll refer to it again in a minute, is just how frequent are these kinds of problems? If the sorts of things that I'm talking about are really unusual, then doing something about it's more likely to make things worse than to make it better. But if this sort of strategic behavior that makes money for the hedge fund and its investors but destroys value for other people is common, then we need to be a little bit more worried about it. Here's the final scenario I want to talk about, and that is hedge fund manipulation in bankruptcy. It looks a lot like the initial scenario. Example of this is situation where a hedge fund buys 1/3 of a class of debt in bankruptcy. For those of you who have not taken bankruptcy or don't follow bankruptcy, the voting rules in bankruptcy require, to oversimplify slightly, that 2/3 of any class of creditors or shareholders approve a proposed reorganization plan. What that means is if you buy 1/3 of a class of debt, you have a blocking position in that class. You can prevent any reorganization plan from being approved over your objection. So if you are a clever hedge fund or other investor, one thing you could do if you want to make money by manipulating the process a little bit is buy 1/3 of a class of debt, buy a blocking position, and at the same time short the same debt. And what you do is you buy that blocking position, you interfere with any reorganization plan that comes down the pike. You make it clear that you're going to interfere, which, if it works, will diminish the value of the debt, and you'll be able to profit from your short position. I say on the slide, this is the problem Black call the empty voting problem, in which was referred to, I think, by the Vice Chancellor. It's actually not precisely the same problem, but it's a very similar problem. The problem is that you have a hedge fund whose control rights are not congruent with their economic rights. They have control in this class of debt, but what they're doing with the control is not to increase the value of the debt, it's actually to destroy the value of the debt, and they can get away with that because they don't bear the cost of the debt going down. All sorts of ways you can do this sort of thing in bankruptcy. You can buy pieces of different classes of debt, you can short stock and buy debt, all sorts of ways you can do this. Again, it's not entirely clear how common this is. It's probably not happening in every bankruptcy case, but it's happening, it probably is happening in more than 0 cases. This is not a trivial concern. Those are the kinds of cases or the concerns one might have about hedge funds in the bankruptcy context or in and around bankruptcy. What solutions are there to these problems, or what might we think about doing to respond to these kinds of concerns? Well, with respect to the loan-to-own problem, the second scenario I talked about where the hedge fund lends money to the company, then buys the company, simple solution is for bankruptcy courts to police this and to cast a cold eye on situations where a lender is also turning around and offering itself as a buyer. In my own view, this scenario shouldn't be prohibited altogether, but courts should police it pretty carefully, among other ways, in how they structure the auction for the company's assets and what they make available to other bidders. So there are ways to police the loan-to-own problem. How about the first and the third problem, the problem of strategic manipulation of the process by using control rights in a way that hurts other folks but helps you? There was a case last year, actually, in the bankruptcy of Northwest Air that suggests the most obvious solution to this. The particular context of the Northwest Air issue was a group of hedge funds had formed an informal committee. They weren't a formal bankruptcy committee, but they'd gotten together to act as an informal committee in the bankruptcy case. It turns out there's a bankruptcy rule that says which probably nobody had even thought about before this case, but there's a rule that says if you form an informal committee to act in the case, you have to reveal name, rank, and serial number and a lot more. You basically have to reveal when you bought your position, how much you paid for it, how much you have. What the bankruptcy court said in Northwest Air is, well, the hedge funds have to do that. They have to disclose what their stake is, when they bought it, how much they paid for it. That, at least superficially, is one obvious response to concerns about hedge fund manipulation. If we knew what kind of a stake hedge funds had, which classes they have a stake in, whether they've shorted the same stake that they own, a lot of these problems disappear because people know what the hedge fund's incentives are. This is sort of similar to the kinds of proposals that Hu and Black make for more disclosure of hedge fund positions. This particular case is going beyond that. And there is a concern for the kind of disclosure that the bankruptcy court insisted on in Northwest Air is what I refer to as the secret sauce problem. The complaint that hedge funds make is that if you require them to disclose when they bought, how much they bought for, you are essentially destroying the proprietary value of their investment strategy. If we can figure out when they bought, how much they paid, you're lifting the veil a little bit too much, and you're interfering with the hedge fund secrets that they ought to be able to keep. You are requiring them to disclose their secret sauce. So that's an argument, and a persuasive one in my view, against the kind of extensive disclosure that the Northwest Air bankruptcy case following the bankruptcy rules insisted on. On the other hand, a less intrusive form of disclosure, something a little bit more like, I think, 13D, and Troy can speak to this better than I can, something that at least gives investors a sense of what a hedge fund's true economic stake is. I think there's a pretty good argument for that kind of disclosure, for beefing up the disclosure requirements. I think this is true outside of bankruptcy, definitely true in bankruptcy in my view, that there ought to be a way that people know exactly what stake hedge funds have. If they've got a stake in one class of debt, if they've got some countervailing stake, there ought to be a disclosure, at least if they have more than a de minimis stake in the bankruptcy process. Okay, conclusion of all this, as I said at the outset, hedge funds bring many of the same upsides and downsides to bankruptcy as elsewhere. The upsides and the downsides stem from the same kinds of factors. They have huge amounts of capital at their disposal, even now. The availability of new financial instruments, which they've been among the most active in using, and the general lack of transparency in the hedge fund world. One issue that I haven't talked about, which I'll just flag now by way of conclusion, is the role of hedge funds as themselves troubled entities. What are some of the problems we're going to have when hedge funds fail and when they start to run into trouble, as they are now? In the bankruptcy context, one problem people are starting to talk about is this redemption issue that the Vice Chancellor talked about in a healthier context a little bit. What sorts of problems are there going to be with redemption? And there are a bunch of problems there are going to be, starting with the fact that in bankruptcy terms, redeeming your stake in a hedge fund right before bankruptcy looks an awful lot like a preferential transfer, and you might have to give that back. Another problem on the compensation issue, some folks think that when hedge funds start to lose value, it's going to create distorted incentives because of the compensation scheme. We heard earlier that actually the percent of assets aspect of compensation will have a beneficial effect. Maybe that's right. But some people think that once hedge funds are way below their benchmark values, so the 20% performance fee is just not, the hedge fund managers just aren't going to get that their incentives to actively run these funds are going to diminish, and we may end up with some zombie hedge funds that are just sitting there. Managers are collecting the asset fee, and they're not doing anything with them because there's no hope of getting a performance fee. One silver lining of these coming hedge fund failures, and the ones that we're in the midst of, is that I think in the bankruptcy process we're going to learn a lot more about exactly what hedge funds have been doing. You cannot be non-transparent in bankruptcy. So when a hedge fund is in bankruptcy, we're going to find out what it was doing before bankruptcy. The analogy here, which is not original to me, but I like it, is for a hedge fund bankruptcy is going to be a little bit like the black box in an airplane after an airplane crashes. When they file for bankruptcy, we're going to see what they've been doing. The real silver lining of that is I think we'll have a much better sense of how worried we ought to be about the problems I've been talking about and whether they're not really serious problems. So, we have a minute for questions. Sure. Fritz?
Thank you. David, this was very impressive and very informative, but I just asked myself...
I knew there was going to be a but at the end of that.
There is always a but. Yeah.
There's always a but.
Are the problems you have been talking about really specific for hedge funds? Hedge fund may be more likely to engage in that sort of activity, but must it be necessarily a hedge fund? Or could it also be, let's say, a rich private investor who is playing around with a lot of money? And isn't that true that your answers also were not really specifically addressed to the structure and problems of hedge funds, but to the problems of bankruptcy? Particularly with your second example, this was in a way a new duty involved for participants in a bankruptcy proceeding, regardless of the structure they have, and the sort of answers to the other two problems, number 1 and 3, may look similar. That everybody who is engaging in that sort of activity will have to disclose the strategy. Wouldn't that be correct?
To start from the beginning of your question, isn't it true that these problems are not unique to hedge funds, that there's nothing about a hedge fund that this is not about hedge funds. It's about a problem that is correlated with hedge funds, but not necessarily limited to hedge funds. That is absolutely right. And in my thinking about hedge funds over the last couple years, I've really come around to the conclusion that there aren't really hedge fund specific problems. My own view is that I know just trivially little compared to what Troy knows about the standards for accredited investors and things of that sort. I don't think that's where the problem is. I think the problem is more the kinds of things I've been talking about, and they're not specific to hedge funds. I think there's a pretty close correlation, however, and the reason for that is the sorts of folks who have had the ability to have huge pools of money that they can do these kinds of things with really have been hedge funds and equity funds. Equity funds typically don't do these sorts of things because equity funds, at least historically, have had more of a long-term perspective. They haven't been going into companies to make a profit in 3 months. They've been going into a company to make a profit in 2 years or 5 years. Same thing with, venture capital funds often are equity funds. So although these problems aren't unique to hedge funds, they're not limited to hedge funds. As a practical matter, I think a significant majority of the time when they surface, it's hedge funds are where they surface just because of the nature of hedge funds.
Thank you.
Doug's going to hold that up there.
It's that one. All right, thank you, Professor Skeel. And now for the final presentation on our program this morning, we're going to shift gears to an international experience with hedge fund regulation. And we'll hear from Douglas Cumming. And he is an attorney, a PhD and CFA, an associate professor of finance and entrepreneurship, and the Ontario Research Chair at the I'm sure I'll mispronounce this, Schulich School of Business, York University. He has previously taught at the University of Alberta School of Business, the University of New South Wales School of Banking and Finance, and the Lally School of Management and Technology at Rensselaer Polytechnic Institute. His research is primarily on law and finance, hedge funds, venture capital, private equities, and IPOs, with a focus on public policy and the international differences across Europe, North America, and the Asia Pacific. His recent publications have appeared in or are forthcoming in the American Law and Economics Review, the Cambridge Journal of Economics, and numerous other prominent journals. He was the recipient in 2004 of the Ido Sarnat Award for the best paper published in the Journal of Banking and Finance for a paper on full and partial venture capital exits in Canada and the United States. Professor Cumming has also consulted for a variety of governmental and private organizations in Australasia, Europe, and North America. So as he speaks to us about the international aspects of hedge funds, he's got quite a wealth of experience to bring to us. Thank you.
Thanks very much. How do I, is Shivram here? Yeah, I'd like to pull up the slides.
Okay, and it's this.
Lost our expert.
Okay, now we've got to get to yours.
Decades? I don't see it up there. I'll just...
We have our...
No, I'll just put it. Pull up on the slides. Yeah. Great. Which one? Forward? Yeah. Great. Excellent. Thank you very much. It's a privilege to be here and be part of such a distinguished panel, and I thank the organizers for the invitation to the event. I should begin by acknowledging the contribution of my co-author, who is also my wife, and as I like to say, if there are things you like about the paper and presentation, please thank my co-author. If not, I'm here to take the blame and questions. Indeed, there's a lot of talk about hedge fund regulation because the regulation in the U.S. is best described as perhaps being scant. Why is the concern with their concern with regulation? Well, the market's really large. A few years back, estimates were in the neighborhood of being over $1 trillion in capital under management. More recently, I've seen some statistics suggest it's now over $2 trillion in the very most recent estimates. And this gives a variety of reasons for concern, apart from just the size. For instance, most funds will promise their investors alphas. That means the risk-adjusted performance relative to what we would expect based on some capital asset pricing model, are promising alphas in excess of 5%. And so if you just do the simple math on the conservative estimates of $1 trillion of capital under management, basically means that there's roughly $50 billion in returns that haven't been picked up by the rest of the market. And that's a big number to suggest that markets are inefficient. Is that likely? Probably not. So what does that imply? Well, it perhaps implies that there are going to be many disappointed investors in the future. And given that the SEC, amongst other regulators around the world, are in the business of protecting investors, it suggests that perhaps something ought to be regulated. So our interest in this stream of papers that we've been working on international experience with hedge fund regulation, in this particular paper looks at the question of whether or not there's forum shopping in hedge funds. And that is, hedge funds need not register themselves in the U.S. They can pick a different jurisdiction in which to register. And in fact, there are international differences with respect to hedge fund regulation, as we'll explain in a minute. So just as we can address this issue with respect to corporate law, is there a race to the bottom? Is there a race to the top with respect to companies incorporating in Delaware or other jurisdictions? We can ask a similar question vis-a-vis hedge fund regulation along the lines of whether or not funds pursuing riskier strategies register themselves in different jurisdictions with perhaps more scant regulation. There's a variety of papers on hedge fund structure and performance, more recent work on hedge fund activism, share restrictions, some work on the U.S. experience with hedge fund regulation. I've done some stuff on the performance of hedge funds in respect to regulation, suggesting more regulation is associated with worse performance. Although what's unique about this particular paper is that we're the first to look at forum shopping in the context of hedge funds. We ground our work in the context of agency costs and fund strategies, very much along the lines of the most recent presentation by Professor Skeel. And what we see in the international arena of hedge fund regulation is that it's very easy to characterize international differences in regulation along three main dimensions, which is in fact done by industry analysts such as that of PwC among other analysts, which is there are differences in minimum capital requirements. Some jurisdictions have location restrictions on key service providers of the funds. And thirdly, there are rather distinct differences with respect to how funds can be sold. So while in the U.S. we have private placements, in other jurisdictions funds can be sold as wrappers through fund distribution companies, investment managers, banks, and indeed other financial service providers that may or may not be regulated. So given these differences in how funds are regulated in different jurisdictions, it's worthwhile to consider whether or not funds pursuing riskier strategies and strategies with potentially more pronounced agency problems systematically select different jurisdictions. And that's the question that we consider in this paper. So what we do at the beginning, and those that know me know I'm a data person, so I will get to data in this paper. But before doing that, what we first do is consider differences in fund styles in relation to agency problems, and then relate those to forum shopping. So certainly we might argue that funds, some types of hedge funds are pursuing less risky strategies, and indeed we might take issue on which are less risky and more risky strategies. But I think a fairly well accepted categorization might be along the following lines: that market neutral, certainly fixed income arbitrage. If you know anything about hedge fund strategies, you've perhaps seen fixed income arbitrage strategies as being described as analogous to a steamroller rolling down the street and picking up nickels. So we're effectively looking at very large funds picking up differences in interest rates to arbitrage at a relatively riskless or risk-free profit. And indeed, there are other arbitrage strategies that we might characterize as having relatively less pronounced agency problems. By contrast, just as Professor Skeel had pointed out in a number of very good examples, some strategies are perhaps better characterized as having more pronounced agency problems. Those might include long-short, and indeed one example given there is that it could be possible for a fund to simultaneously invest. Say take a really extreme example. A fund manager could operate more than one fund. In one fund, go long on the S&P 500. The other fund go short on the S&P 500. Collect management fees of 1 to 2% on both funds, and performance fees on one of the two funds. Indeed, that wouldn't be so good for the investors, but it's certainly possible through that type of scenario. There are other agency problems with long-short that were discussed earlier. Microcap and distressed companies, indeed with companies with illiquid stocks or facing bankruptcy problems, there are, as we just heard earlier, agency problems associated with those types of fund strategies. And likewise, CTAs and managed futures indeed also might involve relatively more pronounced agency problems. So just to elaborate on a couple of the examples, I did give the long-short example of pursuing offsetting strategies. Why might fund managers not recognize this? Well, there's a lot of mumbo-jumbo, if you will, if I can use that sophisticated terminology, going along with marketing strategies, so it's relatively easy to disguise, or possibly easy to disguise precisely what it is that the funds are doing. With microcap funds, really, or microcap strategies, really what's going on is that share prices are so illiquid that the largest size of the hedge funds make it, and the large trades make it relatively easy to manipulate share prices in a way that they can profit relative to other investors. And then, indeed, with the distressed companies, we have funds that can take both debt and equity positions in a company, and certainly there's no Glass-Steagall-like restrictions on hedge funds, although certainly regulators have imposed those types of restrictions on financial institutions and in other contexts. So the long story short, with hedge fund strategies, some indeed have pronounced agency problems, others do not. And the other aspect of our story, of course, is that hedge fund regulation is different in different countries. And the nice summary of this is provided annually by the PwC report that talks about hedge fund regulation around the world. And the ones that are highlighted are minimum capitalization requirements, restrictions on location of key service providers, and the distribution channels that we had talked about. And so what we do in the paper, I apologize for the smaller font, but it's hard to get this all onto a single slide. But effectively what we do is we have a data set that combines the two different data sources where we've eliminated any overlap, because some funds only report to one data provider. So what we did is took two different ones, CISDM and Hedge Fund Net, and we have funds from a variety of different countries around the world, some offshore, some onshore. In this slide, you first see the number of funds registered in each jurisdiction as per these two data sets. And then, as well, we've summarized minimum capitalization requirements in each jurisdiction, and then indicated by way of binary variables 1 or 0 whether or not the marketing channel is permitted in that particular jurisdiction. So this is just the same information for the next set of countries. And so, as you know, for the U.S., for example, we have no minimum capital requirements, permissible distributions through private placements, and no restrictions on the location of key service providers. That, for example, is fairly different relative to, where's the example? You could, well, for instance, I'm from Canada. You could look at that as an example where there's a bunch of different distribution channels, no restrictions on location, no minimum capital requirements. Another big difference is in Austria, where there's large minimum capital requirements, distributions through banks and wrappers and the like. And so without going through all the examples, sort of the broad international landscape with hedge fund regulation. Just quickly, what is it that comprises a hedge fund? And we talk about this a bit in the paper, and also put up this nice graph or figure, if you will. And that is, there's a lot of people involved in a hedge fund, and the key service providers summarized here. Don't think it's necessary to go into too much detail. But so what are possible hypotheses that we want to test in this particular paper? First of all, you might consider that there's potentially a race to the bottom. So as an easy example with respect to restrictions on location, if it's true that funds pursuing riskier strategies systematically select jurisdictions that do not have any restrictions on location, where there's potentially greater oversight of fund activities, then we might be concerned that there's a race to the bottom, if you will. Conversely, if there's the third hypothesis, if funds pursuing riskier strategies select jurisdictions where there's more onerous regulation, then we would suggest there's an alignment of interest between funds and their investors. And why might that be the case? Well, it's certainly possible that by picking a jurisdiction with regulation that's more suited to the investor's interests, then they're not going to be having as great a problem in their capital raising, amongst other things. The third possibility, outlined as hypothesis 2 in this slide, is that it's just completely random. There's no systematic forum shopping with respect to fund strategy and where a fund manager registers their fund. So those are the three main alternatives that we consider. And let's just show you what exists in the data. We do run some regressions and present summary statistics and the like. We're mainly interested in the relationship between fund style and where they've registered the fund. We do control for a few other things that for the most part are effectively robust, so whether or not we put them in or not as control variables. And so what do we see? Well, the things that I'd like to highlight primarily are, first of all, that on average, there's relatively little jurisdiction shopping with respect to fund strategies systematically going into different jurisdictions. And where we do see jurisdiction shopping, it's in fact along the lines of an alignment of interest and not counter to the interests of the fund investors. So just to point out a few examples of this, which I've highlighted in blue font, fixed income arbitrage strategies, ones that we described as massive steamrollers rolling down the street picking up nickels. They indeed are more likely to register in jurisdictions that have larger minimum capital requirements, less likely to register where there are private placements. If I can point out another example, tech sectors, less likely to register via banks, less likely to register in jurisdictions with marketing managers. As another example, one I haven't yet talked about is marketing via wrappers. A lot of the practitioner literature describes the wrapper jurisdictions as involving relatively more pronounced agency problems, in that fund managers can disguise their activities, more easily misreport monthly returns, and disguise it with the products that are being sold contemporaneously with the wrapper. Indeed, we see little or no jurisdiction shopping with respect to wrappers. If I point out two more here, and that is with respect to the restrictions on the location. First of all, we see that emerging market funds and CTA managed futures, both of which involve potentially more pronounced agency problems are in fact more likely to select jurisdictions that restrict location. And so that is certainly, if anything, suggestive of an alignment of interest with investors if those jurisdictions have relatively more pronounced regulatory oversight. Conversely, the one is with respect to, that I haven't yet mentioned, the last one that I'll talk about in this slide is that technology sector less likely to pick jurisdictions in which there are restrictions on location. And that's actually a fairly non-surprising result insofar as hedge funds that are in the tech sector the managers do like to be relatively proximate to their investments. And just as to give you an example, when I had a nice year down in Sydney, Australia, had a good friend working as a hedge fund manager there in a fund that was actually a U.S.-based fund, but it was very important for him to be based in the Asia Pacific for various reasons associated with the fund. And so for that fund, it would have been extremely inappropriate for them to be registered in a jurisdiction that would restrict domicile. So what we can suggest for the overall picture, again, as I said, very little forum shopping. Where we do see forum shopping, it's suggestive of an alignment of interest and not counter to investors' interest in a race to the bottom. So this slide, this is with our combined sample where we've mixed two different data sources together. Secondly, we did this, econometricians were always really big on robustness to see if things are robust to doing it different ways. So we did the same thing by just using one of the two data sets. And to make a long story short, the results are extremely similar, except with one exception, that is there are comparatively fewer statistically significant effects, suggesting that this forum shopping is not a pronounced as pronounced in just a single data set. But again, a lot of the things that we talked about in the prior slide, for instance, emerging market funds, more likely to select jurisdictions that have restrictions on location and the like. Okay? If I could, again, highlight a few others that I like to. Tech sector funds with potentially more pronounced agency problems, less likely to be marketed through banks and investment managers, et cetera. So that's and then we have the example with Professor Skeel of distressed securities, less likely to be picking jurisdictions with marketing channels through banks. To flog the dead horse, if you will, not agency problems, but alignment of interest. Okay, so what inferences can we draw from the data? Little evidence of forum shopping based on strategy. Where forum shopping exists, it's indicative of a race to the top, not a race to the bottom. Riskier strategies are more likely to be found in jurisdictions with relatively more pronounced regulations. Why might that be the case? Well, the best explanation that would be consistent with the data is that fund managers pick jurisdictions that are going to facilitate capital raising of the fund. There's always caveats when looking at any question empirically. I could have written a paper either way that said forum shopping is problematic, isn't problematic. I could argue it either way till we're blue in the face unless we look at the data. That's why it's important to look at the data. We're the first to look at a data set on this topic. There's always possibilities of gathering more data and potentially in future years as regulations change in different countries, possibly, then that could give rise to new similar research questions to be answered in the future. So again, thanks very much for the opportunity to have it present. And as I like to say, my co-author wife that I'm always indebted to, if you like the presentation, then please acknowledge her. Otherwise, I'm here to take the blame. Thank you. Any questions? Yep.
I'm wondering whether the data you got is broad enough to go cross-sectional analysis that that sort of holds in time the content of the PwC rankings of statutory environments, and that raises a few concerns. One might be that the statutory environments are in fact a response to the anticipated population of hedge funds, as opposed to the opposite direction, or some third omitted variable is driving both of them. And so one possibility, if this PwC thing is published every year, is you could actually try to observe changes in governance profiles and try to predicate your analysis on switchers, people that switch jurisdictions. Is that something your data would admit? Have you tried to do it? And then a sort of a second question is to even sticking with the cross-sectional approach. A test of a race to the bottom versus race to the top requires you to independently be able to assess which of these regulations is investor friendly and which ones are not, right? And do you have an independent way to assess that other than to see that you get a certain type of fund matching up with a certain type of regulatory structure?
Number of good questions there. So let me just first jump to the main regulations again. And these regulations are... So the regulations, indeed, we have gone back in time at this stage and tried to find changes in these regulations over time in these different countries. And what we've discovered is that they're extremely stable on these dimensions. There are subtleties within each of these countries where regulations have changed, although on these broad-based dimensions, like, for instance, distribution channels through banks, take an example of the U.S., never been possible with hedge funds. With Germany, always been possible. So those types of these types of regulations are not things that change a lot over time. And so on those, so to get at that empirical question, does a regulatory shift where we're going to all of a sudden change the distribution channel to give rise to a switch in registrations, we're not able to get to that particular question. So it is in fact a cross-sectional look at, given this set of regulations, where funds choose to set up. It's not a perfect experiment, but in social sciences we're limited to what the world presents to us, and we can't, unlike chemistry, throw different things into the mix to see what comes out. So that's pretty much where we're at. Then the second item is the extent to which these regulations are or are not investor friendly. And the best that we can really do is go back to what people write in the academic and practitioner literature. For instance, with respect to wrapper distributions and other distributions that provide relatively greater access to retail clients as opposed to just large institutional investors, we would suggest that, consistent with that literature, if funds pursuing relatively more pronounced strategies with relatively more pronounced agency problems, select those jurisdictions that have less oversight or distributions that give them access to a broader client base, and that'd be suggestive of a race to the bottom. That's the main thing that we can do is effectively is ground ourselves in what other people have written on the topic.
All right. Thank you very much.
Thanks very much.
I just want to thank all of our morning presenters, especially Vice Chancellor Parsons. I know he's busy, and we really appreciate him taking time out to moderate this panel, and all the presenters. Right now we're going to break for lunch. I believe lunch should be outside or coming in the next few minutes. So in the meanwhile, you guys should feel free to get some coffee. And then we're going to have another presentation at 1:15 in the adjoining room, and that's going to be by Professor Henry Hu. And he is going to be talking about hedge fund voting strategies, and a lot of these presenters have been referring to that, so it should be a very good presentation. So once we get lunch, you guys are more than willing to start eating lunch, and then around 1:15 or so, or 1:10 or so, we should probably all go in there and see Professor Hu's presentation. Thank you.
Very much.
Very nice to meet you.
too. Same.
Like I said, feel free to get some coffee, and the lunch should be here in the next few minutes. Welcome to the second half of the session. I'm sure some other people will come in the next 5 or 10 minutes, but we might as well get started here. Our moderator for the second half of the panel is Tom Donaldson. Tom is a Wharton professor. He's the Mark O. Winkelman Professor at the Wharton School. He's also the director of the Wharton PhD program in ethics and law, and I'm sure that he'd give an interesting take on hedge funds and ethics and law and how that all goes together. He's written broadly in the area of business ethics, values, and leadership. He has written several books on the subject. His book, The Ethics of International Business, was a winner of the 1998 SIM Academy of Management Best Book Award. He's the president-elect of the Social Issues and Management Division of the Academy of Management and a founding member and past president of the Society for Business Ethics. His writings have appeared in publications such as the Academy of Management Review, the Harvard Business Review, Ethics and Economics and Philosophy. So without further ado, Tom Donaldson, who will introduce this area. Thanks.
Thanks very much. I hope everybody can hear me. My hat is off to those who organized this forum, because I think it deals with one of the most important issues confronting Western society, not just American society. I was intrigued to hear about this morning, a morning of discussion I was not able to make. I had another commitment. And interested to hear that the bugaboo is off, that the great fears about hedge funds have been abated. There was a sanguine tone to this morning's remarks. For me, I'm scared as hell about hedge funds. And I'm reminded that what we don't know can sometimes not only hurt us, but the mere absence of transparency in itself can distort market forces. No less an economist than Stiglitz describes the Asian meltdown of a number of years back as occurring primarily not because there was a spate of bad businesses, but because the absence of transparency failed to allow market participants sufficient knowledge to determine which bets were good, which bets were bad, and to act accordingly. We now have trillions of dollars invested in hedge funds. No less a business theorist than Warren Buffett professes not to understand how the model works. 2 and 20, 3 and 30, that is 2% annual fees plus 20 or 30% of the profits. These are huge incentives. And they're motivating managers in a context where there is some good and some bad rationale for not disclosing strategies, not disclosing positions. I've been on CNBC twice commenting on hedge funds, and on the most recent appearance, the issue was remuneration. It for me, was testimony to how deep some of the prejudices about regulation lie. I was taking the view that there wasn't any real reason why the head of Goldman Sachs should be taxed at a much higher level than the head of a hedge fund. And that was before I saw the banner line under which the whole, Harvey Pitt was the other sort of talking head on with me, former SEC head. And that was before I saw the banner line for the whole segment that we were on, and it was called The War on Prosperity. As if to say anybody who would suggest, and Congress was suggesting at the time, that a change in the tax laws might be envy about the high remuneration of hedge fund managers. At any rate, with that as an introduction, let me say we have three excellent participants today: Eric Talley, Jennifer Ralph Opold, and Scott Musoff. And we'll take them in that order. Our plan is to have each person present. I'll give a very brief introduction for each. We'll then have a little time for questions, but we want to chunk up some time reserved for the end for the panel to talk a little more freely among themselves, and also for all of us to kind of get into the act. Eric will be speaking first. His topic is strategic pre-litigation trading by hedge funds. Eric specializes in corporate law and economics. He is the co-director of Bolt's Berkeley Center for Law, Business, and the Economy. Welcome.
Thanks, Tom. Notwithstanding the fact that I had instructed Tom to read Richard Booth's credentials when introducing me. So I want to thank the Journal for putting on this event. It's great. Shivram, you're out there somewhere. You are one of the most polite, pushy people I've ever met. And I mean that as a compliment, because it'll get you far in this profession. So I'm going to say a few words. It's a little bit more of a hodgepodge about some issues that I've been working on involving pre-litigation trading strategies among hedge funds. A lot of hedge funds, somehow I got into this evil cabal of hedge funds in the Bay Area, and I'm not sure exactly how it happened, but I find myself pretty frequently at their events, and I get a chance to talk to them. I guess that's a version of field experimentation, but it's often done on their dime. And some of the things I was working on, and I'm going to get to that at sort of the end of the presentation, were relevant to some of their trading strategies. And so, part of this is going to be a lead up, and part of it is going to be sort of throwing out an idea that's half-baked, undoubtedly, and I'm not sure whether it is beyond half-baked, whether it's creative or crazy, or maybe a little bit of both. So I'll bounce both prospects off of you. First of all, props to Troy from, well, I don't know where he went. You still out there? He left. Oh, there you go. So one of the things in your discussion this morning about SEC regulation got my wheels churning. For about the last 7 months, I've been noodling around with some of the data, the very brief life and death of hedge fund registration under the 1940 Act. And remember, even going into the rule change that Troy was talking about. This has nothing to do with my paper, but I just thought it'd be interesting to put a couple of these things up there. Going into the rule change, there were some hedge funds that had already registered. They were either ERISA hedge funds or they had already registered on their own accord. But in that sort of 6 to 8 month period, there were about 1,300 hedge funds that registered. By filing a Form ADV under the 1940 Act. And they didn't look just like all the other hedge funds that were out there. And so this is actually from the investment advisors data set between 04 and 06. And this is sort of one of the things that the Form ADV requires you to report on is what's your establishment size in terms of number of full-time employees. And one thing that's definitely true is these registering funds were smaller than the balance of the funds out there. Much larger mass point at that sort of 1 to 5 category. And by the way, just to go back to a point from this morning, that sometimes hard to identify hedge funds. So our definition is funds that first filed an ADV in this time span in which registration was required and had the type of investors that a hedge fund usually has. So it's probably over-inclusive, but interesting nonetheless. And they're also smaller by other measures. So the total number of registrants was about 1,365 of new ones compared to around 9,000 pre-existing. The mean number of accounts was about 400 as opposed to the average investment advisor had far more. And the mean assets under management were around 606 million as opposed to over 3 billion for some of these other ones. So this was a small segment, but remember these purple bars probably include some pre-existing and large hedge funds already in the mix. But kind of an interesting experiment. And just get back to the introductory remarks of Tom. I sort of agree. I'm sort of going to fall in line with people like David Skeel in the following way, that if you were going to try to make a case for regulating hedge funds against some sort of a prior, it's not clear to me that we have enough data or a priori reasons to know exactly how to jump into that process. That doesn't mean that there isn't a prudent form of regulation of hedge funds that's out there, but one of the things that is problematic in this area is a lack of data. Doug's paper is actually one of the more data-intensive studies out there on hedge funds. There's another one by Frank Partnoy, Randall Thomas, and another author that also is a pretty good sampling, and this is just another sort of a window. But one positive economic role of a type of regulation that the SEC rolled out and then rolled back in at the behest of a court was that it provided information that would allow us to study the industry, and that in some ways is a little bit unfortunate. I was going to do a slide on the economic roles of hedge funds, and let me just go over it really briefly to give you sort of a sense. And I think a lot of people have canvassed this. By the way, there is a fine article in the University of Pennsylvania Law Review by Ed Rock, who's here, and Marcel Cahan. I probably would have said that if Ed weren't in the audience, on hedge funds that it recounts a lot of terrific sort of stories about hedge fund activism. One thing that has mentioned a lot this morning is that potentially the glass half full approach of hedge funds is they provide a lot of liquidity and a lot of volume to the markets, and that's important from a standpoint of informational efficiency of a market, to be able to know that the prices of securities that are trading actually reflect the deeper fundamentals of what those securities are worth. You need a lot of traders. You need sophisticated traders. You need traders that are willing to trade in lots of volume to sort of identify mismatches of various types of asset prices, and hedge funds, by their definition, tend to do this. Hedge funds also, in the last couple of years, have become big sort of mavens or watchdogs of corporate governance. And there are a couple of great stories out there. Recently, Harbinger Capital and Jana Partners have been putting a lot of pressure on media companies, Media General and New York Times Company, to change their governance structure. Both New York Times and Media General have classified boards and two-tiered structures, but Harbinger and Jana are actually having some success in at least putting pressure on their deflated stock. Famous case out there covered by Ed and Marcel in their paper about Third Point LLC and their open letter to the CEO of Star Gas, criticizing him for, among other things, placing his mother on the board of directors, and that's sort of a form of shaming that probably Third Point is the high watermark of that, but undoubtedly a fair amount of activity. People mentioned also this morning that you can have sort of Henry Hugh got into this a little bit, but there have been some occasions in which there's sort of a sense that hedge funds will take small positions and, while not officially coordinating and therefore not falling under Williams Act requirements, will approach a board and say, hey, listen, we could easily get together and collectively we would have a 30, 40, 50% share of the company. Jana Partners has also been quite involved in the Bay Area with CNET as an aggressive potential acquirer and proxy challenger JANA is aggressively trying to expand the CNET board so that they can actually place a majority on the board in addition to the 2 who are up for election this year. And then finally, kind of I think an econo head, and I'm an econo head, I'll out myself right here, might call this sort of an off-equilibrium threat. The hedge funds have played a greater role in litigation. They don't always have to play a role in litigation for litigation to matter, but CNET itself has been subject to a lawsuit by JANA partners in Delaware, claiming that a bylaw provision that prohibits a shareholder from bringing forward a slate of directors, even at their own expense, from doing so for a year is a violation of Delaware law, and that is pending. The well-known Hollinger versus Black case was a case that actually got started by a hedge fund that then backed off when the company took it upon itself to pursue the action. And then sometimes there's securities litigation by hedge funds against companies. Now, class actions, you'll sometimes see class actions that have a lead plaintiff as a hedge fund. That's sometimes a little bit tricky because if you've got a hedge fund that's in a net short position, as Vice Chancellor Parsons explained this morning, that person may not be a very adequate class representative because the stakes of that entity are not necessarily the same. But it's, to the extent that that often happens, it's actually fairly common, or surprisingly common, I guess, that hedge funds will sometimes end up at the front end of a securities class action, and will often at least threaten individual or securities class actions as kind of a way to bargain towards a governance change or towards representation on the board. So one thing you have to remember that litigation not only is a threat as exercised, and we can observe situations where hedge funds have played a pretty pivotal role in litigation, but the threat of litigation can actually be the baseline from which a hedge fund ends up being able to bargain for governance changes or other sorts of goodies that wouldn't appear on our sort of data set as being involved in litigation, but it was a background threat the entire time. So that's kind of a sense in which, and that's why I would refer to this as kind of an off-equilibrium threat of litigation. So let me talk about 3 or 4 different litigation-related trading strategies that hedge funds either can play or do play. I'll kind of start more with the do's and then maybe go towards the cans and then end up with the mights. So one sort of an interesting subsegment of the hedge fund market is a group of hedge funds that basically engage in crisis arbitrage. They end up making purchases of some form of company securities on the heels of some or spurred by some sort of a crisis at the firm. And you might think that often that's going short in a firm because the crisis at the firm means the firm's going to tank, and these firms and these companies end up, or these hedge funds end up shorting the firm in a crazy way. And some of that indeed happens. But you can also find examples of hedge funds that go long in firms that are in crisis. So there are a couple of them in the Bay Area, for example. Fishbach Partners is probably the most famous one. It's not a very broad hedge fund. It only ends up, its portfolio is about 7 or 8 companies, but it's got a lot of investors, and it finds companies that are in the middle of crisis and for which it believes the market has overcorrected, has overshot on an announcement of an accounting issue. So, for example, they took right after an accounting crisis at United Rentals in 2004. Fishbach took a big position in United Rentals with the belief that the accounting crisis was, concurrent in the wake of a lot of other accounting crises, was essentially overreacted to by the market, and ended up pocketing about a 70% 18-month return on that investment. More recently, over the last couple of years, there have been hedge funds that have taken fairly active roles related to options backdating. And so here's kind of a weird anecdote. That turns out, for whatever reason, that a number of the options backdating scandals took place in the Bay Area as well. And so that's been kind of the Fair Employment Act for lawyers in corporate law practices in the Bay Area. And I was asked by a couple of law firms to sort of look into one aspect of backdating, which is the extent to which backdating practices at firms, if they occurred, and of course the position was that they didn't occur, but if they occurred, whether they were material in nature. And one way that you can measure materiality of a failure to disclose the actual grant date of an option is to look to see whether on announcement of the backdating scandal there was an abnormal return change in the value of the stock, whether the stock moved in a way that you wouldn't predict given the way that the market was moving, where it lost a lot more money relative to what you would expect it would lose when the market, regardless of which way the market went that day. Now, if you look at equity shares of companies, you sometimes will see a slight dip upon the announcement of a backdating scandal, but not with all companies. It was not a momentous moment when just looking at stock returns. And one thing that we tried to look at as well, just to kind of do a belt and suspenders approach, is to ask what happened also with bond returns, because those are another form of investment in some of these companies. And with some companies, you got pretty much a similar pattern, but it was actually even more prevalent that bond prices went up on the announcement of a backdating scandal, which at first struck me as somewhat mysterious. But it turns out that, and a couple of cases over the last couple of years have borne this out a little bit more, that when you have a backdating issue, that will often lead to a delay in filing of financial statements. When you delay in filing financial statements, it's plausible that you have breached a covenant in your debentures, and that can cause a debt holder to try to accelerate payment of principal. And in fact, sometimes you see bonds that are trading below par on the announcement of backdating. That suddenly gives the bondholders a possible option to cash in, and hedge funds were pretty aggressive about taking advantage of this. Another type of crisis arbitrage is actually crisis creation. So Vice Chancellor Parson talked a little bit about the Deep Haven case, about a net short company that was using its long position as a way to acquire inspection rights under Delaware Section 220. Overstock.com has gotten into a kind of a squabble with the hedge fund Copper River that was also in a net short position, and the CEO of Overstock essentially got quite pissed off at them and started making sure that any good news about Overstock was immediately injected into the market, and that created a short squeeze on Copper River, and they ended up losing a bunch of money and then filed suit against him for securities fraud. So in some ways, their short position in Overstock almost caused a domino effect that actually created this form of litigation. And then a third one, and then I'll probably, how am I doing, Tom, on time?
You have about 5 minutes.
Okay, great. So let me talk about a third litigation-related trading role that isn't as much at the fore here, and it's not necessarily directly related to hedge funds. And this is the one that's a bit more speculative, but might be worth thinking about a little bit. And so I'm going to give you, I'm guessing that there are a lot of students here that think they may want to go into teaching someday. I talked to some of you last night. I'm going to warn you, this is a speculative sort of thing I'm going to talk about here. Tenure is strongly advised before you talk about things like this in public. It also applies to any assistant professors in the audience. So here's the deal. So when I started teaching, a long time ago in the 20th century, when I was getting out of graduate school, there was one big puzzle that a lot of my finance professors had sort of put out in front of me. And that big puzzle was as follows. It is really difficult. There's a lot of models of securities trading out there. They're all over the place. And some of the models of securities trading, including ones due to Paul Milgram and Nancy Stokey, who aren't real, usual finance people, is that sometimes you shouldn't observe any trading at all, because anytime someone wants to sell something to you, it means they've got bad information about what they're trying to sell to you, and you shouldn't want to buy it. All right, and that literature has evolved quite a bit in the last 25 years, but it's still generally the case that it's hard for people to understand why we observe the amounts of volume that we do. Usually the best way to explain it from a finance professor's perspective is essentially to assume it, to assume that traders out there have liquidity events and they just have to go out and trade because of some necessary recourse to having to access liquidity in their portfolio. That's never been terribly satisfying to me, and it's sort of been thought to be one of the big sort of David Hilbert-like mysteries in finance. I'm not going to answer that question, but it's what motivated me to get into this issue. As a law and economics person, I was wondering to myself, I wonder whether anything about law could help explain or help give us some insights on volume. And here's one possibility. So don't laugh. I'm just going to throw it out, and then we can talk about it. So going back to the last slide, bargaining leverage and the threat of litigation can sometimes create a lot of room to maneuver for a hedge fund or any other big investor for that matter. And therefore, being able to make a credible threat of litigation may provide sort of the groundwork for being able to bargain for governance changes or board membership or something else in a company. All right? Now, in order to do that, you need to have standing to sue. If you're going to sue as part of a class action under securities fraud laws, for about 30 years, you have needed to be able to demonstrate that you purchased or sold securities during the period in which the fraud was going on. If you were going to purchase securities and then the corporation lied and gave a too negative report or forecast and you decided not to, guess what? You don't have standing. If you had a big position in a company and you were going to sell it, but the company issued this fraudulent, rosy report about its current condition and you decided not to sell, guess what? You don't have standing. All right? So you needed to actually be turning over some of your position during the period of the fraud. Now, it turns out that as a matter of state laws also have their own form of securities laws, and a fair number of states did not have that requirement. They had what was essentially called a holder's lawsuit, in which someone who was just holding on to a portfolio, relying on an overly rosy report, actually had standing in state court. And in 2006, the Supreme Court of the United States essentially said that those holders' actions are preempted under federal law, which essentially means that you've got to be purchasing or selling if you're going to have standing as a securities fraud plaintiff. All right? And so you can kind of see where I'm going on this. But it struck me that this case, it's called Merrill Lynch versus Dabbitt, and there's the citation for you, was a natural experiment to think about whether the purchase or sale requirement, particularly in an era of hedge funds, might have a marginal effect on churn. So, all right, crazy idea, I know, but I was bored, it was the summer, I didn't have anything else to do with my time. All right, so again, the holding basically, it's kind of an interesting case. In some ways, it gives you some faith in companies like Merrill Lynch because you got a stock trader that has no idea what everyone else is doing or has no idea that the analysts at Merrill Lynch are excessively pumping up stocks. And he believes his own analysts, has the gall to believe his own analysts, and decides not to sell his positions for his clients based on those rosy analyst reports, but later alleges that those rosy reports were just an attempt to get more business from these issuers from other parts of Merrill Lynch. And he ends up being a holder, but files as part of a class action and is essentially shut down by the Supreme Court, told that he does not have standing because he did not purchase or sell during the period of the fraud. And one nice thing about this is that it gives you what is close, but not quite, but close to kind of a natural experiment to ask whether the advent of this case may have, and particularly two events, when the case was argued on January 18, 2006 and March 21, 2006, might have created a blip in volume. All right, now to put this kind of test together, all right, what you're going to need to do is sort of say, okay, here's a group of firms that are quite likely to be sued, all right, and after Dabbitt, it's going to be harder to have standing to sue them. You're going to need to demonstrate you purchased or sold because you don't have state law as a recourse anymore. And here's a control group of firms that doesn't get sued very often, and I'll use that as sort of as a baseline control. Can't find a completely good control group, but the one that we ended up choosing here was a very boring group of firms, utilities. And utilities, for other regulatory reasons, have to disclose a lot about themselves, including their cost structure. So a lot about utilities, independent of their federal filings, turns out to be relatively transparent. But companies that get sued a lot are essentially into two industries, high-tech industries and biopharmaceutical industries. And so we sort of use that as a treatment group. So the whole idea is, let's compare these oft-sued firms. Take 2 minutes. all right, off-suit firms to our utilities and see what we get. So I'm going to put a table up here, and then I will essentially end, all right? So there are two things we're looking at, the decision and the oral argument, all right? Both of which, by the way, if you look at the press reports of the oral argument, a lot of press reports were saying the justices were very skeptical of whether you could maintain a state holder's action. So the prediction is that both oral argument and then the final decision should increase volume of our treatment group relative to the control group. And this is the variable of interest. Is this a company? And so we're looking at volume, both 30 days before and 30 days after both of these events. The question is it after the DABIT decision is either argued or issued? And are you in this high-tech or biopharmaceutical against the baseline of utilities? All right, both with oral argument and decision, you do see an uptick in volume in that 30-day window. We do have some financial controls and industry controls in here as well. One thing we can also do is break out these two subsets, the high-tech and the biopharmaceuticals. You get exactly the same sign across both of those subgroups. You lose statistical significance just barely on the biopharmaceuticals when it comes to oral argument. Now, what does this mean? No clue, quite frankly. But if I bring this around to the question of hedge funds, we did this also for some prior events that might have some bearing on this. Blue chip stamps, which is the famous case that initially puts in the purchase or sale. SLUSA, which is the preempting statute. You get the same effect. It's not as strong as it is in 2006. And hedge funds are playing a much greater role in 2006. And so I think in various Forrest Gumpian ways, since I'm out of time, that's all I've got to say about that. So I will leave it at that. Any questions? Fire away.
As far as the data, and I remember talking to you once about this, is it that hedge funds and other investors are actually looking at the results of these cases and therefore trading based upon the results of these cases? Or, I mean, it seems like a kind of non-intuitive assumption to be making.
Yeah, this is the reason why I'm worried about this being a crazy idea as opposed to a clever idea. So one of the reasons I started hanging out with hedge fund managers, and they're perfectly fine people, by the way, but one of the reasons I started hanging out with hedge fund managers, and particularly these crisis investor managers, is to ask them how much of their trading strategy really revolves around being opportunistic. A lot of them, they didn't give me answers that were inconsistent with this approach, but they didn't give me answers that were, oh yeah, this is what we're all about. All we do is we look for, we routinely turn over our portfolio so that we maintain standing in the event that this company ever ends up trading. So, I don't think this is an answer to the volume problem. All right, it's maybe a clever way to test this idea of whether the purchase or sale requirement contributes to the volume puzzle, and it may be. I'll be a little bit more immodest about it. That there's sort of economists sometimes punts on this type of question, Shiv, by saying the following. It may matter whether people consciously think that they're following a strategy, but it may also matter whether people are acting as if they are following that strategy. And that turns out to be a more powerful statement than you would realize, particularly when you're trying to understand the behavior of consumers. I don't know whether it's as powerful when you're trying to understand the behavior of hedge fund managers. I doubt very much that this is at the forefront of the minds of a lot of hedge fund managers. If I had gotten sort of positive reinforcement of this from my discussions with hedge fund managers during this period of time, this thing would already be published, all right? So that's sort of where I'm kind of left. It's an interesting quandary at the very least.
So my question is, if I understand this correctly, then what you're seeing is a fluctuation in volumes of trade as it relates to the decision in the oral argument. Did you, if that's correct, did you try to track the price of shares during those same periods, or in relation to particular stocks?
I've got data on that. I don't have a prediction on which way that would go.
Because it seems to me that would be pretty interesting data in terms of creating a, if you and I want to get together, we can create a hedge fund, and this would be a great strategy to make some money.
Yeah, there is not, on a priori grounds, I can't come up with a prediction of which way the price should move. All I can come up with is volume predictions here. Maybe I'm not clever enough, or maybe I just don't think it yields an unambiguous prediction about which way prices should move. If this is really a kind of a rotisserie sort of churn argument, then I would actually venture to say it would yield no prediction about prices.
You're still stuck maybe relating it to particular companies, right? And so you still...
Yeah.
Okay.
Yeah. Thanks.
Thank you. Thank you, Eric.